Donald Trump's stunning return to power as the 47th president of the United States, with the anticipation of tax cuts, deregulation, and tariffs, has caused sharp knee-jerk market moves worldwide. The US dollar has spiked higher against other currencies, US Treasury yields, equity markets, and even Bitcoin have all surged higher. Meanwhile, gold and silver have sold off sharply from their early November highs, creating a better than expected buying opportunity. But will it get even better? Or are we starting to see the end of these post-Trump win knee-jerk market moves? In this gold market commentary for Friday, November 15th, we'll take a look back at the dollar, gold, and silver and their reactions to the first Trump presidential win in November of 2016. We'll compare that to where we are today, following his election 2 weeks ago. And we'll also take a look at the fundamental drivers that have pushed gold all the way up to 2,800 and see how a Trump presidency and new governmental policies may affect some of those drivers that have helped run gold to record highs. Hi, I'm Dana Samuelson, president of American Gold Exchange in Austin, Texas. We are a national, physical, precious metals and vintage U.S. gold and European gold coin dealership. If we can help you with any of your physical buying or selling needs when it comes to gold or silver or platinum and palladium, we'd love to have that opportunity. So let's get into our update. I've shown you this 7-year gold chart before, which details all of the factors that have driven gold from under 1375 in 2019 to as high as 2800 just a couple of weeks ago. From economic instability to increasing debt to geopolitical conflict, stronger dollar, bank failures, second war breaking out in the world, and central bank record gold buying. These are the factors that have driven gold from 2070 in April of this year, March actually, to 2800 in early November. Now let's drill down a little bit and see which ones might change under a Trump presidency. Well, if we look back at where we were in 2016 and compare that to 2024, you'll see that US debt, which gold has fundamentally been tracking since 2003 or so, was $20 trillion in 2016. In 2024, we're up to 36 trillion now, an 80% increase in 8 years. That's not going to go down. So our debt is going to continue to go higher, and that will help to buoy gold as time passes. Gold is inversely correlated to the dollar and treasury yields. So as they go up, the gold price tends to go down and vice versa. These are a short-term driver of gold and silver, and they don't tend to take long-term multi-year plays. So there's an inverse correlation, but they're one of the ones that affect the gold price most immediately in the marketplace, and it can come and go. When Donald Trump was elected president in 2016, we had geopolitical stability. We had peace. Now we have geopolitical instability. We have 2 wars, 2 big wars in the world. I do believe that Donald Trump will help to get the Ukrainian-Russian conflict settled pretty quickly. There's some talk in the wind that may actually be starting to happen already. So I think we might have one less global conflict. The other one is the one that worries me. We'll talk a bit more about that in a bit. Inflation. In 2016, the CPI was at 2.2% and sideways. And then, of course, we had rampant inflation, and we're back down to 2.6% today. So that's not changed very much overall, although we are seeing inflation moving from sticky to stuck. And I'll drill down on our inflation latest information data in a bit. De-dollarization. Well, the de-dollarization movement was non-existent in 2016. The BRICS nations existed as a 5-country bloc, which is now a 10-country bloc, but there was no challenge to U.S. hegemony in 2016 as there is today in 2024. Now, this is a slow train, but it is coming. And then, of course, there's been record central bank gold buying since 2022, and it's the most fundamental driver of the gold price. In 2016, when Donald Trump was elected president, central banks bought 400 tons of gold, which was pretty big for them at the time. This year, I think we'll go a little over 900 tons of gold, more than double. So we'll drill down on that a little bit because I think it is the most pertinent factor in underpinning the gold price and helping to drive it higher over time, which goes with the de-dollarization movement as well. So let's look at the charts for the dollar, gold, and silver when Donald Trump was elected in November of 2016. These are all 2-year charts. This one is of the dollar. And you can see where Donald Trump won the presidency for the first time on November 18th, 2016. The dollar was just under 99 on the dollar index. It dropped a little bit, but ultimately it gained 6% up to 103.30 between election day and the end of the year, 2-month time. And then over the next 2 months, it gave up almost all of those gains, surged a little bit, and then dropped dramatically. So we had the similar knee-jerk reaction in the dollar when Donald Trump won the presidency the first time, as we are seeing today. We'll get to that chart in just a minute so you can see for yourself. But this puts into perspective what happened last time with the dollar and how gold inversely correlated reacted at that time. Gold was just about 1270 when Donald Trump was elected in 2016. It sold off sharply in response to that stronger dollar down to 1130, an 11% sell-off at the time. And then by the end of February 2017, we'd seen a 10% rebound. So gold dipped and then came back and regained all of its losses. So this was a good buying opportunity for gold. And as you can see, as the rest of the year transgressed, it was the best buying opportunity for gold. So that's what I'm seeing here today. As I think we're getting a pretty good buying opportunity. It's just will it get a little better? Let's take a look at silver. Back then, silver went from 1850 down to 1580, a 15% sell-off. And then it V-shaped rebounded just like gold, up 14% back to 1850, almost gaining everything that it lost over that 4-month period. And then it went sideways, grinding a bit lower. As you know, silver is more volatile, but the fundamentals under silver are much better today now than they were in 2016. And I detailed that in our Is Silver Ready to Run video. So let's get into some of the fundamentals now that we have seen what happened the last time Donald Trump was elected president. Well, first of all, here's a chart of our debt. When Donald Trump was elected, it was 20 trillion, and now we're at 36 trillion. And our debt has doubled in each of the 10-year periods from 2004 to 2014, 14 to 24. The question is it going to double again between now and 2034? We're at 36 trillion today. So are we going to get to 72 trillion? Is anyone's guess. Our estimated interest expense, according to the global debt clock, is now $993 billion, just under a trillion. We'll get there before the year's over $1 trillion in interest expense, and our defense spending is below that. So we're spending more on interest than we ever have, and it's about to be the highest interest bill we've ever had at over $1 trillion. This will not change, not materially in the short run. Our debt is going to continue to move higher. That'll help to drive gold higher. I showed you this chart in our last update for the first time. This is a gold chart that labels every conflict that's occurred or interaction that's occurred between Israel and its Iranian enemies, proxies, Hezbollah and Hamas and Iran, since that war started a little over a year ago. Gold has climbed a wall of worry over this conflict. You can see where Donald Trump has won off to the right there and how gold has tumbled. And that's more due to a stronger dollar than anything else in the short term. But there's also talk now that Russia and the Ukraine may work towards a settlement. Donald Trump will push that, and I think it will probably happen, and probably pretty quickly. So we may see Russia keep we will see Russia keep the ground that it's already gained in the eastern Donbass region of the Ukraine. And in exchange, Ukraine will annex that out to Russia and exchange that for peace and sovereignty for a while longer. But the Israeli-Iranian conflict bothers me much more because of Donald Trump's support for Israel and his dislike of Iran. He's basically told Bibi Netanyahu, do what you need to do. And Bibi Netanyahu has been relentless in going after Israel's enemies, both Hamas, which has been decimated in the Gaza Strip, and Hezbollah, which has been decapitated in Lebanon. And now these two inter-exchanges of warfare between Israel and Iran directly. Israel has been held in check by the Biden administration, who's pushed Israel to respond proportionately and militarily to military targets. I don't know how Donald Trump how much he might untether Bibi Netanyahu. But Netanyahu knows this is his chance. And if he really takes it, that could be a real problem. So time will just tell. We'll have to see. This is the one that worries me and continues to worry me. So we'll have one less war in the world, but the one that matters more may become a little bit bigger before it diminishes. Time will tell. Let's move over to inflation. Here's a chart of the consumer price index going back to 2000. And you can see off to the right, the yellow highlights, we're starting to see CPI inflation, both headline and core, turn up a bit. And that's detailed in the text on the chart with headline CPI inflation gaining 0.2% between September and October, while core CPI inflation is basically unchanged for the last 4 months. I think inflation's going from sticky to stuck. And this could be a problem, especially if it continues to resurge. That will give the Fed a problem, who's been trying to cut rates to bolster the employment market, stimulate business activity to keep hiring people. But if inflation resurges, they'll have to ease, which will they'll have to hold the rates higher for longer, which may impact the U.S. economy. So the Fed is getting into a bit of between a rock and a hard place right now as inflation goes. But so far, so good. We'll see how time passes, if this is just a blip or not. But if you drill down on the producer price index, which lists prices for finished goods by producers here in the U.S., it's been doing nothing but rising for most of the year. And this does not bode well for inflation taming down. These are the prices that producers get for finished goods. And that's been rising, which is a bad sign. So Donald Trump may be getting a bit of an inflation problem when he takes office. And we'll have to see what the Fed does in reaction. Just yesterday, Jerome Powell said that they may ease back a little bit on their rate cutting because of this inflation print. And that took some steam out of the stock market just today. So the rubber is starting to meet the road between employment and inflation with regard to the U.S. economy. We're going to see who wins over the next several months, and that's going to be a problem Donald Trump's going to have to deal with. With regard to the de-dollarization movement, this is a picture of the BRICS meeting that was held in Kazan in October. No new BRICS currency was announced. But what was announced is that the BRICS nations, the 10 BRICS nations, are working towards creating an alternative to the US-based SWIFT international bank transfer payment system. Now, the BRICS nations had no motivation to move off of the SWIFT banking system until we sanctioned Russia following their invasion of the Ukraine in 2022. But now they have motivation to do so. And the international settlement of payments through a new bank transfer system of their own design will allow them to do less and less business in dollars over time. Now, it'll be years in coming, but it's coming. It's a slow train coming. But what the BRICS nations have been doing is buying gold at record rates, and they have been using gold as a settlement vehicle instead of dollars. That's not going to change even under a Trump presidency. So that's going to remain a constant, I believe, and will only probably grow as time passes, which will be beneficial for gold. Let's drill down just a little bit further. This is a 72-year chart from 1950 to 1922, showing net central bank buying and selling over that period of time. And you can see for most of that time, central banks were net sellers until the great financial crisis hit and the post-great financial global debt explosion occurred. Central banks started buying gold as a hedge for themselves against their trading partners, other countries who are growing their debt just as fast as everyone else has been exploding their debt, like the US. This is a drill down on that period of time from 2010 to 2023 that shows how central bank gold buying doubled following the Russian invasion of the Ukraine from 500 metric tons a year to over 1,000 tons a year in 2022 and 2023, which has helped to buoy the gold price. And taking this a little bit further in time to today, this shows the same data from 2014 now into 2024. This is from the World Gold Council that shows how many tons of gold central banks have bought through the third quarter of this year, which is around 700 tons. I think they're going to get to a little over 900 tons of gold, making 2024 the third largest buying year, just under 2022 and 2023 over the last 10 years. I think the higher price of gold internationally has impacted the buying capacity, dumbing this down just a little bit, but still they're buying gold at near record rates, and I don't think this is going to change. So fundamentally, debt, inflation, geopolitical, physical demand, those things are going to continue for a while, especially three of them. We might see the Iranian-Israeli conflict resolved, but it may be a little while. Meanwhile, we've got a fairly decent US economy and inflation that's kind of tame, but maybe resurging a bit. So these are the things that Donald Trump is going to inherit. Most of them remain very bullish for gold over time. So let's drill down a little bit on what's happened just since he won the presidency. Well, putting into perspective what's happened with the dollar, this is a 3-year US dollar chart that shows where the dollar's been. It made a moonshot in 2022 when the Fed was jacking the rates sharply, and then it came way back down once they started to ease a bit. For most of the last 2 years, the dollar's traded between 101 and 105.50 on the US dollar index chart, with a couple of pushes just over and under that. I've labeled all the highs so you can see where today's high at 106.85 comes into perspective with the previous two highs in 2022 and early 23, a little over 106. It does look to me like this run in the dollar is starting to exhaust itself. Let's go to a 1-year chart, and this shows how the dollar was rebounding anyway heading into the election because the US is just a better economy than the global economy. We got a lot of weakness out of Europe in October, specifically Volkswagen's in pretty big trouble. It's one of the engines of the German economy, no pun intended. So that helped to buoy the dollar against the euro currencies, so the euro and the British pound. But now the dollar's taking a real run from 103 to almost 107. But again, it looks like it's starting to run out of upside momentum. So you can see that a bit more clearly here in the candlestick chart going back 6 months that shows a more granular look at what the day-to-day trading has been like down to the low in October. We did gap down lower at one point in time in September, which is unusual. And we did gap higher the day after Donald Trump won. And you can see that tear that the dollar's been on. Almost every day has been higher except for one since he won the presidency. Off to the very top right, we hit 107.12 yesterday intraday. That's the high so far. The dollar is weaker than that today. I produced this chart while the market was still open, which is why that candlestick all the way to the right is black and yellow, but the dollar's a little bit lower today. And the chart seems to be losing momentum. So it could go a little bit further, but I think that this dollar move higher is starting to exhaust itself, which would be good for gold. Now let's just take a look at one other thing that's material, and that is the 2-year federal funds rate and the 10-year US T-bill yield chart. You can see yields have jumped since Trump has won from about 4.25 to 4.3%. Not much higher, but the direction has been stronger all along since October. That's helping to hold gold in check. The latest Fed funds rate cut is not on this chart, so the Fed funds rate's really about 4.6 today, just over the 10-year Treasury yield. But again, this chart is a little choppy, and I do think the yields are starting to hit highs. We'll see. If that's the case, gold will start to gain some support. And here is the 1-year US gold chart. So you can see where we started the 12 months ago in a rolling basis at about 1975, with gold at about 2650 today. We've got still a 30% gain. Most of that started in March, and then gold consolidated through the summer, and then we had that big run from August all the way to 2801 in late October, early November. There's Donald Trump winning the presidency, gold coming down, breaking that blue uptrend line, and now breaking through the first layer of support where I had it at 2620. I've put an intermediate level of support in at 2560, which we're testing right now. But ultimately, I see real support at 25 and a quarter, not much lower than we are right now, with the next layer of support at 24 and a quarter. So that, I think, is the downside risk to gold. Let's look at the 6-month candlestick chart, which gets a bit more granular, and you can see basically the same thing. We got support at 2620, which we've broken, but the steam is starting to lose momentum, or the downward trajectory is starting to lose momentum. I've put that intermediate support level at 2560 with real major support at 25 and a quarter. You can see off to the right, yesterday's tick lower down to about 2540 and then closing back up. So gold is starting to be bought pretty well at about 2540, and the next layer of support's right under that. I think in the current market, gold under 2,500 is going to look very cheap to people, and it won't get much lower than that if it even gets there. We're testing 2560. Maybe we leak a little bit more. Buying kicks in at 25 and a quarter. Maybe we get to 2,500. At 24.95, I think there's a lot of buying that comes in, to be honest with you, because it's a psychologically attractive number and it's just below major support. I don't think gold's going to get much cheaper than that. If it does, the next layer of major support's at 24.20. So that's what we're looking at. But if I'm correct in assuming the dollar is starting to top out and treasury yields are starting to top out here, then we would see gold rebound from here. So I like gold under 2550. I really like it under 2500, and I would back up the truck at 24 and a quarter because I do think the fundamentals remain very strong for gold. Let's look at silver. This is a 1-year silver chart. Shows basically the same thing, only in a bit more choppy manner. Silver did break out over 3250 in earnest in October. Its high is 3504. It was already correcting when Donald Trump won. And right now it's holding support pretty good at 3050. The next level of support's at 29. And then the next major support level is at 27. I think silver is going to look very attractive if the price goes under $30 an ounce. On a 12-month rolling basis, we've got silver going from about 23.50 all the way to 30.50, which is still a 29% gain, which is a pretty big gain for silver on a 12-month rolling basis. Right now, major supports at 30.50. We're leaking a little bit this afternoon on that. So I would look to 30 or 29 as a real opportunity to buy in, especially under 30. Here's a candlestick chart that shows you the same thing. We're testing 30 and a quarter. On this chart, we got a little bit under that yesterday. We're higher than that today, which is not shown on the chart. And of course, the next level of support is right there at $29. So silver under $30, I think, is going to look very attractive, and I would take advantage of that myself. Here's a gold to silver ratio chart. The ratio remains high at about 84 to 1, which means silver is cheap relative to gold. When gold was $200 higher and silver was $200, the ratio was about the same 3 weeks ago, 2.5 weeks ago, as it is today. So silver remains cheap relative to gold. So those are our charts. These are the specials right now we have at American Gold Exchange. We've added a $20 St. Gaudens in MS65 condition. It is the most popular of the vintage U.S. gold coins pre-1933. It's trading today at about 17.5% over its intrinsic gold value, which is about as low as we ever see the premium on this coin over gold trade at. So it's a great value. With our $50 discount, it's coming in at a little bit over $2,900 per coin today, with about 750,000 known examples, if I remember correctly. We also have a French 20 franc on special at just 4% over gold value. Supplies are really tight, so we could run out of that at any time. That's a great value in physical gold. And in silver, we have 2024 Silver Eagles, 50 cents off. And a few of those Britannias dated 2023 from Great Britain are still kicking around. 70 cents off, as low as 33.26 today. Basis silver at about 30.45. I'm sorry, 30.25, 30.27. So, as always, I cannot thank you, our loyal customers, enough for the trust that you've placed in us over the last 26 years. Without you, we wouldn't have a business, and we are grateful for you and the loyalty and trust that you've placed in us, and we are every day. This will be my last update till after Thanksgiving, so we hope that you all have a wonderful Thanksgiving holiday. I'm off to the New Orleans Investment Conference next week. Any relevant information that I gain regarding the U.S. economy or how the Trump presidency might affect both the economy or precious metals going forward, I'll be sure to share with you in our next update. Until then, have a wonderful, safe Thanksgiving holiday, and thank you again for everything.